Translation of foreign currency in financial statements when you prepare consolidated financial statements on a worldwide basis. The foreign currency financial statements prepared by foreign operations must be translated into the parent company's reporting currency. The two major issues to be concerned about: 1. Which method should be used, and 2. Where should the resulting translation adjustment be reported in the consolidated financial statements? Translation methods differ on the basis of which accounts are translated at the current exchange rate and which are translated at historical rates. Now, accounts that are translated at the current exchange rate are exposed to translation adjustment. Know that different translation methods give rise to different concepts of balance sheet exposure. Under the current rate method, all assets and liabilities are translated at the current exchange rate, giving rise to a balance sheet exposure equal to the foreign subsidiary's net assets. Whereas stockholders' equity accounts are translated at historical exchange rates, and the income statement items are translated at the average exchange rate for the current period. Appreciation of the foreign currency results in a positive translation adjustment. Depreciation of the foreign currency results in a negative translation adjustment. When we translate all assets and liabilities at the current exchange rate, we maintain the relationships that exist in the foreign currency financial statements. But because we translate assets carried at historical cost at the current exchange rate, it results in amounts being reported on the parent's consolidated balance sheet that have no economic meaning. Under the temporal method, assets carried at current or future value, cash, marketable securities, receivables, and liabilities are remeasured at the current exchange rate. Whereas assets carried at historical cost and stockholders' equity accounts are remeasured at historical exchange rates. Expenses related to assets remeasured at historical exchange rates are remeasured using the same rates. Other income statements items are remeasured using the average exchange rate for the period. When liabilities are greater than the sum of cash, marketable securities, and receivables, a net liability balance sheet exposure exists. Appreciation of the foreign currency results in a remeasurement loss. Depreciation of the foreign currency results in a remeasurement gain. Remeasuring assets carried at historical cost at historical exchange rates maintains the underlying valuation method used by the foreign operation in preparing its financial statements. Remeasuring some assets at historical exchange rates and other assets at the current exchange rate distorts the relationships that exist among account balances in the foreign currency financial statements. The appropriate combination of translation method and disposition of translation adjustment is determined under both IFRS and US GAAP by identifying the functional currency of a foreign operation. The financial statements of a foreign operation whose functional currency is different from the parent's reporting currency are translated using the current rate method, with the resulting translation adjustment deferred in stockholders' equity until the foreign entity is disposed of. Upon disposal of the foreign operation, the accumulated translation adjustment is recognized as a gain or loss in net income. The financial statements of foreign operations whose functional currency is the same as the parent's reporting currency are remeasured using the temporal method, with the resulting remeasurement gain or loss reported immediately in net income. Know that the factors used to determine the functional currency of a foreign operation differ under IFRS and US GAAP, and that there is a substantive difference in translation rules between IFRS and US GAAP relates to foreign operations that report in the currency of a hyperinflationary economy. Lastly, understand that some companies hedge their balance sheet exposures to avoid reporting remeasurement losses in net income and/or negative translation adjustments in stockholders' equity. In addition to derivative financial instruments, such as forward contracts and options, companies often use foreign currency borrowings to hedge their net investment in a foreign operation.